up? I'm Russ, and this is my little old channel, Dapper Dividend. So, I was going to do this as a video, but I thought, you know what? I'm going to do a little bit different. It's been a while since I've been live. Now, I'm going to put a hard stop probably at about 8:30. I want to keep this about 30 minutes long. I got a podcast to do for those of you that listen to the podcast. Excellent. I'm going to have a really interesting topic about what you should be doing through a market crash in your 20s, 30s, and 40s. Talking a little bit about Cisco there, what we're going to cover right here on the channel. So, yeah, without further ado, we will get into it. So I'm going to just give a quick little bit of a rundown here about what went on with Cisco. And spoiler alert, I bought more Cisco. They dropped 14% after earnings, after they had a little bit less than stellar report. But I listened today while I was actually welding. So I am a welder. I've been doing that for almost 23 years here in the Chicagoland area. I'm an industrial and commercial loading dock equipment installer and servicer, perform maintenance and stuff like that. So listen to the earnings call, really reassured me. And then I went out and bought some more Cisco. So yeah, they dropped 14%. I think that the main point that they wanted to drive home is that their demand is still there. The demand is good. Their total product order growth was up 8% year over year. So as they said in the earnings call, this is all a supply issue. It's not a demand issue. And that is what was really bringing it down was China, the shutdowns, the lockdowns in China, which they didn't expect, and then Russia, Ukraine, and Belarus. So obviously that disruption over there, they've kept, they have Ukraine, they're not getting it from, but Russia and Belarus, because I don't know, it's the new axis of evil, I guess. They're on the list. They're on the naughty list for what they're doing. So they had 1% of their revenue coming from there. So not huge. Let me bring up my chat here for all y'all people out there. Yeah. So where were we? What happened to my restream? Hold on. This is the joys of live. Steve, what's up, man? Glad to see you here. I'll take questions in a minute. I'm gonna get through my little bit of notes here. I got a little screen share to do, and let me bring it back up here. So yeah, where were we? They said demand is still high. They had a record quarterly backlog of over $15 billion. So again, they just have those parts, those products backing up, waiting on China, which they say they're going to come out. Shanghai says they're going to reopen about June 1st. If that's going to happen, I don't know. They don't know. They don't know exactly what that's going to mean. Is it a full reopen? Are they going to have essentials? We don't know what they're going to do. They don't know. But June 1st is the date. Now, I find it really interesting that Cisco has said they're redesigning about 100 plus products to have that component diversity, meaning that they don't want to be so reliant on a country just shutting down like that and completely disrupting the flow of their business. So in a way, I think it's kind of good that they're going to be more diverse and not just beholden on one country. So that's kind of what's cool. Like I always say, these businesses are living, breathing entities, and they're going to do what it takes to survive, and they're going to make shifts to their business plan. So it's kind of right. It's kind of like structural and what they're really going to be doing going forward. They weren't expecting it. Now, they have a couple competitors from what was brought up in the earnings call. I'm not terribly familiar. If you are, let us know, with Arista and Juniper. Now, they said that their quarter, because it ended in March and Cisco's ended in April, that they didn't really get that full quarter, that full period of lockdown in China affecting their business. So they think that they would have been much worse had their quarters ended in April when Cisco's did. So that's something that's interesting. Now, what I do love about Cisco is their $21 billion of cash. Now, that's cash and short-term investments on hand, $21 billion versus their $11.5 billion of short and long-term debt. So right there, after debt, that's giving them a net of about $9.5 billion worth of cash. So that balance sheet, unless I'm missing something, to me looks pretty good. My little welder's eye, if I see something wrong, or if I've missed something, I think they look really good with their cash flow. So one quote that they had that I loved was, they said, year to date, we have returned a total of approximately $10 billion in value to our shareholders via cash dividends and stock repurchases, and more than $17 billion is available under our board stock repurchase authorization. So they have more than 17 billion bucks available to buy back those shares. They think the shares are cheap. I think the shares are cheap, and they're going to be buying them back, I am sure, while they're down around 40 bucks a share. This is the lowest they've been in quite some time. I think they're down 35% year to date. So I think that management's going to take advantage of this and probably go a little bit heavier than normal in buying back the shares, which is great because those shares outstanding are down 21.7% since 2012. So if you're new and you don't understand that, companies will buy back shares, take shares off the market, right? Because when a company puts shares on the market after the initial public offering, they get that money, and then that's it. Those are our shares, our ownership. And if I were to sell a share to you, Cisco sees none of that. So whoever I bought those shares from, Cisco doesn't get any more money. So they increase your ownership in the company automatically by taking shares off the market. They're buying shares, their own shares back, I guess putting them in treasury, if I understand things right. And what that does is that increases their earnings per share because there's less shares out there for the earnings to be spread over. So again, it increases your ownership in the company without you having to do anything extra. Getting close here. Wrapping up, I'm excited to talk to some of y'all people out there. Hold on, let me toggle one thing here. Yeah, okay. And what was I saying? Dividends. So about to those dividends, they are currently 38 cents a quarter, about $1.38 annually. And that current dividend yield at close today, which is May 19th, 2022, is 3.64%, which is pretty high above their 5-year average. So I'll show you that in a minute. I'll pop on Simply Safe Dividends. Now, they have, we'll get into that. Let's go to Simply Safe Dividends right now. Please bear with me, all y'all. I've got to share my screen. Let's see here. You're going to see my restream pop up here for just a second. Let's see. Fantastic. Screen's not sharing. Brilliant. As I put on my, by the way, this is a Clorox product, Burt's Bees Chasmic, as my daughter called it when we were young. Here we go. Now, Daddy's learning how to do all this. So we're sharing the screen. Let's talk to you about Cisco. We'll do a quick rundown after I get a sip of the old Kool-Aid here. All right. So here we are inside of Simply Safe Dividends, 91 dividend safety score. That's with good reason. 2.7%. They grow their dividend a little bit slow. Would like to see that grow a little bit faster. My shares, I linked my Schwab account to Simply Safe Dividends, and it doesn't repopulate till later tonight. But I did buy 4 more shares down between 41.50 and 43.50, I think. We got a couple more. But here we go. Just real quick, the dividend growth. The last 5 years, 9%, 28% the last 10 years. They've only been paying that dividend for 10 years now. And the last was a little bit slow. Obviously, COVID and things like that have an effect with the supply chain, yada, yada. So it's still nice, though. Looks nice up and to the right. Again, we said 38 cents a share. Cisco's pays out $1.52 annually. And the ex-dividend date passed on April 5th. And here we are, that 3.64%, 23% above the 5-year average. And the Forward PE is 11.4, which is what, 20 something as well? I don't know, 21%. I'm terrible at math. I barely graduated high school. But yeah, anyway, so if anybody knows what that is, that difference, feel free to pop it on in. There we go, buried at the bottom of the 52-week price range, topped out at 63.90 cents, 63.96. Their PE below the infotech sector. And yeah, so here we go. Free cash flow payout ratio, 45%. So that's super low. Just remember that. We love looking at the free cash flow payout ratio, and we like to see that low because the earnings per share, as we talked about with buying back shares, can be a little bit manipulated. That's why if a company buys back a crap ton of their shares and the revenue is flat or decreasing, we could see an increase in the earnings per share, right? Because there's less shares that are going around in circulation to spread those earnings over. So we always love seeing free cash flow because free cash flow should be really hard to mess around with. Free cash flow, sorry, the Clash song was going on in my head there. Jenny Jones in a rock and roll world. Earnings per share up and to the right. Oh, whoa, whoa. Hopefully this isn't too loud and I'm not blowing your all's earbuds out. Sales growth, a little bit choppy. That's probably the only bugaboo there. Earnings per share starting to come back up. Again, here's the shares outstanding we talked about, just nicely buying back those shares down to 4.23 billion. And the sales, want to see sales going up and to the right. Fantastic return on equity and return on invested capital. 27% for ROIC. And the way that this was explained to me is that 27% means that for every $100 that comes into the business that they make, they're keeping free and clear $27 of every $100 is their profit, is the way I understand that. If that's wrong, let me know in the comments below because you know where the comments go. Stupid. Operating margin, fantastic. Free cash flow margin, fantastic. The net debt, basically a pristine balance sheet. Again, there's really no debt because they have more cash than debt. And last, the interest coverage ratio, 36.52 means they have $36.52 of operating income to cover every $1 of interest expense. So there is no problems paying the interest on that debt. All right, so I don't know. I think I covered a lot of it. That was pretty good. 12 minutes. So yeah, if anybody's just joining in, all 7 of you, I love it. Thank you. Yeah, you can watch it back from the beginning. So like I said, I got a podcast to do. So if you haven't listened to the podcast, go on all the major podcatchers and you can just hop on there and check out Dapper Dividends podcast. It's kind of like this in a way. I wish I could integrate this live stream with my podcast. That would be kind of fun. So here we go. Let me get to the comments starting from the beginning. I'll just pop them up here. On the bottom, you see that? Nice. Steve, thank you. It is nice to see you all. Sense of urgency to jump in this tech drop. Just Jack Black says, just can't figure out what to buy beside Microsoft. Buy what you know. Honestly, Warren Buffett, right, always wanted to stay out of technology, and with good reason. So we know people use Microsoft, they use Apple, they use Google. We may not have to understand how it works, but we know what it does. And just knowing what it does and knowing that everybody's using it is good. And if you feel that sense of urgency, man, you might want to listen to your gut. This is not financial advice, just my opinion. From what I've found is what I did with Target, actually, $159.99. I did a foot in the door position, just bought a share of it and wanted to get that going, because I find once I own a stock, then I am so much more likely to follow that stock. And it's just, you kind of keep tabs on it a little bit more. So yeah, we don't know how low Microsoft's going to go. I don't know. I could pull up the chart and just kind of see when, just kind of see where the support and resistance line is. But yeah, maybe I won't do that. Anyway, it's getting down there. I know it's here, check this out. All right. Let me share my screen again. Just for you, Jack. Just for you. I will plug in good old Microsoft just so I can see how far it is. Um, I know their dividends, 99, very safe, and fast dividend growth. Excuse me. Look at that. Yield's almost 1%. So it was way below the 5-year average. Yeah, see, we do. I have 2 shares at 202.97, and that's in my self-directed IRA. Yeah, look at those. See, this is the thing you got to kind of wrap your head around is like it's not even 1%, but look at the growth. If they consistently keep growing the dividend like that, man, that's going to start adding up really quickly over the years. So 11% was their last increase, 9% CAGR the last 5 years, and 13% the last 10, which is just phenomenal. 11-year growth streak, 15 years uninterrupted. And what was I pulling this up for? Oh, yes. The 5-year average, though, is 1.34. So that dividend yield is still below the 5-year average. So, you could kind of use that as something to look out for. Maybe you want to wait for it to get 1.25%, something like that, closer to that 5-year average. And yeah, check that out. The 52-week price range was up from 343, and it's getting close to that 243.12 to the low. And I think a lot of eyes are going to be on Microsoft. And we don't have to go through. Just a solid company. I think they may be one of the best run companies on the market. Just a ton of free cash flow per share. Just such a solid company. Buying back shares, really high return on invested capital, 49% return on equity. That's because they don't. It's a really light, it's not a capital intensive business. I mean, just all around pristine balance sheet, ton of interest. Microsoft is just such a solid company. I would not. Yeah, I'll do that. 1 second, Steve. Let me get through these. Let me run through them a little faster here. SCHD is now about 3%. Nice. I do have SCHD and DIVO. So I started a wedding fund for my daughters, doing $50 a month for each kid. So $100 a month on the 15th goes right into that little fund I set up. And I'm alternating between SCHD and DIVO because I love covered calls. So that covered call ETF. What do you got, Steve? You own some Cisco. Good. Yeah, my favorite. Here, I messed up. Some of my favorite tech plays at the moment, Jack Black. I'm not really that big into tech, kind of like Ian Lopik with the CPGs, the consumer packaged goods. But I would stick to what I know personally. That would be Microsoft and Apple paying the dividends. And then even Google, I know they're running into some issues with advertising and YouTube actually losing not losing revenue, just not as profitable as it once was. So, I would just say Microsoft and Apple. Everybody knows them for a reason. They're fantastic. You are welcome. Clifford, there you go. Says that Cisco's a top 10 holding of SCHD. I did not know that. I'm sure I've read that, but my God, we have so much going on in our heads. Can't remember everything. This is why a community is fantastic, and I'd love to know your opinions. If something's right, wrong, bang, let us hear about it. Let us know. There we go. Can I use Simply Safe Dividends to check HCSG and SCCO? I will, Steve, just for you really quick. I won't go through them too much so I don't want to bore everybody, but I actually don't know what those are. HCSG. There we go. HCSG. Healthcare Services Group, dividend safety score of 78, 5.04% yield. Slow dividend growth. We'll just go look at their dividend growth here. It's been slow. I don't like to see that. Very nice yield, though. So this kind of reminds me of Verizon, but I'm familiar with Verizon. Healthcare could be interesting because, especially here in the United States, I know they're always trying to get that bill or have Medicare being able to negotiate. And, there's always that single payer that's looming. So that could affect things. Looks like they pay every quarter, 85 cents annually. That dividend yield though, The average of the 5 years, 2 and 3 quarters. Um, yeah, and they're down 32 for the high. They're down to 15, but their PE is still 24.8, which is way above. It's weird. They're in the industrial sector. So, and then let's see. Ugh. Yeah, I don't know. This looks, I'd have to dig into this, but earnings payout is kind of high. Again, that's, I don't know. Is this a REIT? I don't think it's a REIT, is it? Um, anyway, housekeeping and laundry. No, that's not a REIT. Yeah, I'd look into that a little bit more. And I think SCCO is what, Southern Copper? Copper's been high, just sold a bunch of pennies. There you go. Dividend safety score of 24 unsafe. The ceiling's coming down. So unsafe. Oh, God. Okay, everybody, check this out. Look at this. It's a roller coaster. This is not what you want to see as a dividend investor. I mean, just cut it during the pandemic, then it went sky high, and then it's coming down in 16, cut up. Yeah, that's too much jerking around. So Southern Copper, I know it's probably, no, it's not even up because of the copper. I know copper was up. So 8.59% yield. Yeah, that's a little too rich for my blood. I would stay away from good old Southern Copper. All right, what do we got? What do we got? What do we got? Don't go fast, go slow. Motor Mouth. Look at this. Nora. What's up, Nora? What time is it, by the way? I'm going to give you guys 10 more minutes because, like I said, I got a podcast to do. Dude, we're rolling, we're going. I love it. Talking my dividends. Nora the Stock Explorer. I say she's the queen of the live stream. I'm always getting the notifications, Nora. My apologies for not popping in more, but I get so much. That should be my spring cleaning, right? I get all these notifications on my phone all day long. But if you like live streams, then check out Nora the Stock Explorer, the queen of the live stream. She's always on there. Fantastic. And what we got? Citizen of the Year. What's up? What's up, Citizen? Go all in on BlackRock. Yeah, I saw that. You were buying BlackRock. I'd like to buy BlackRock. Let's take a peek, everybody. Come on, everybody. Let's get in the, I don't know what to call it. Let's get in the share screen machine and look at good old BLK. I know they're probably going to be solid. Yep, 98 dividend safety score. Check this out. Yeah, it's, I probably should just do it and do my foot in the door position. 18% was their last increase, 13% 5-year CAGR, 12% 10-year CAGR, 12-year growth, 18-year uninterrupted. Nice. Yeah, just $4.88 a share. Current PE, or current dividend yield, is 34% above the 5-year average. So, man, look at that. And the forward PE is below the 5-year average. And check that out, everybody. $971 was the 52-week high, and they are square at the 52-week low. Their PE is still a little bit over the financial sector, and yeah, we don't need to go through it too much. I know this is probably murder on your eyes if you're watching on a little tiny screen, but they're a solid company. That's all we need to know. And yeah, they're a little bit pricey. I always like buying full shares. I'd have to stave up a little bit for that one, but I am sure that I have, exposure to it. In fact, I know I have exposure to it in some of the mutual funds, the Vanguard mutual funds that I'm in through my IRA with work. And yeah, Simply Safe Dividends is really great. It's a little bit pricey. I think it's $399 a year. You get what you pay for. I love it. It's fantastic. I'm using it to show more on the YouTube channel. So I just feel that the few bucks I get literally from this channel, if anybody wants to know, I think I'm averaging about, God, I don't know, 100, maybe 125, $130 a month from this channel on YouTube, which we got to pay taxes on. So I'm kind of doing this out of the love for it. I love it. I want to just grow, talk to people more, love the community. Let's see. Yeah, there you go. Okay, well, I have SCHD. Thank you, Clifford. BlackRock is in SCHD. So, dude, that is fantiddly-tastic. that I don't own it outright, but I do have exposure to it. And that is the beauty of ETFs, because SCHD is what, like 75, $76 a share. So just for that little bit of money, you don't have to buy the whole thing, but you still get exposure to these wonderful businesses. Let's see. What do you got, Jack? KDP. I did a video on KDP. Um, yeah, long on Pepsi. On KDP, we like KDP. There's Keurig Dr. Pepper, by the way. My daughter owns it because she likes Dr. Pepper. So we bought, I think, a share or two of Dr. Pepper that she's dripping. She's dripping the KDP in her account. We have the custodial we have set up. Yeah, so KDP not quite as good as Pepsi or Coke. You know, it's one of the lower tiers, but they're dividend safe, and I don't know. I did a video on them not too long ago, maybe a month ago. It was like one of those 3, 4, 5 stocks that I think it was in the freaky fast growth. I don't know. I guess somebody probably knows. Let's see. What do we got here from Citizen? What do you think about YouTubers who promote hype stocks and are down big right now? Dude, yeah, you got me on this one that I'll keep it nice. I've seen a lot of, and we can expand this to the crypto market, that I don't like it. And I tried to play around with it. I think the last I did was a video on Palantir, but I wasn't hyping it. I even think I said I wouldn't buy it, but a lot of people were talking about Palantir, so I wanted to get more views. And that was the early days of my channel when I was doing crypto. I was doing, like these growth stocks, these hyper growth names. But I won't say them by name just because I don't want to do it. But there's a bigger YouTuber, over 500,000 subs, and for a while there, every day was Neo on fire, rocket ships, buy Neo, buy. And then it just started coming down, and dude doesn't cover Neo anymore because there's not that white hot fervor for it. So I don't like it. And the way I do it on here is I'm trying to stick to either things I am doing that I've bought, like with PepsiCo. I bought those 100 shares. That was a fun video, by the way. If you haven't checked it out, fun little intro I had putting together with a couple, speaking of YouTubers, bigger YouTubers than this channel for sure. But we, hell, I don't know what I was going to say. I don't like it. I don't like people pumping, but this is why you got to do your own diligence, right? You bring up a great point because, man, you can't just buy, and I've done this. I bought based on people's recommendations. Don't do that. If you do, you're not going to have the same conviction as them. And if you didn't do the research and you didn't do the due diligence to give yourself that conviction, then when the price dips, like Amazon, what I think a few times went down like 75, 80%, something like that. I mean, people with conviction held, people that didn't have conviction because Uncle Larry told them to buy AMZN. They sold because they're like, crap, I'm down, I'm out. So, I want to say his name, but that's wrong. I don't want to trash talk anybody else. You can probably figure it out. Finance YouTuber, over 500,000 subscribers, almost every day, maybe even twice a day, was doing Neo videos, and now the Neo videos have stopped. So, yeah, you agree. Good. Yeah, so what we got here? Maybe like one more minute. I don't know. What do you guys want to say? One more thing, because I got my podcast to do. Of course, I got 17 viewers now. I love it. I appreciate all y'all. If you listen to the podcasts, I'm going to roll right in there. So, yeah, I'll go one more question. Who wants to give one more question? Anything. I don't care what it is. Give me a question about hell. I don't care. What do you want to know? How about I just sit here and look into the camera until somebody says, oh, here we go. I saw it out of the corner of my eye. Let's see. What is this? Oh, there we go. Oh, here we go. Here we go. What stock will I do? You're asking what will I hit 100 shares of next? I don't think I'm going to be doing that right now. I did enjoy it. And it's weird because this is the first time since June of 2020 that I'm not buying a share of Pepsi. So um, I'm just working on getting it down now because it was like 13.5% of the combined portfolio. So I'm just going to try and chunk that down and I'll do that by just investing in other things, everything but Pepsi. And naturally, those positions will start to come up and Pepsi's going to comparatively come down in portfolio size. So yeah, that's what I'm doing. Probably not anything exact. So, hey, I love it. Thanks for joining me. I'm going to sign off. Again, if you want to listen to the podcast, I'll say hello to all y'all. I'm literally going to shut this bad boy down, fire up the old Anchor app, Anchor. I'm going to fire up Anchor and just do my podcast there. I got some information. We're going to touch on Cisco again. So that'll be redundant. Oh, here we go. Sorry. Jack Black. This is the last one. Cubs or White Sox? Cubbies, because my grandfather was a Cubs fan and it was always on. I have very fond memories of being a kid in the yard and he would put uh, WGN radio on. I was a kid. I used to hear Harry Carey. So summers in Berwyn, Illinois, in my grandparents' backyard, just just fond memories of the Cubs, Harry Carey. I remember my grandpa hit a homer, Ryan Sandberg, and then Sammy Sosa when he came along, he'd always watch it. Hit a homer, Sammy. So yeah, Cubs, man. I'm Cubs fan. My wife's a Cubs fan, so that was next. And then this is the last one. Watch this. I had to put you on because you said thanks. You subbed after I was on IWHR with Curtis. Okay, cool. Well, I appreciate that, man. I haven't heard from Curtis, but I haven't reached out either because I get so busy. If anybody wants to get a hold of me quick, head to Twitter at RustyRam78. Send me a private message because I get those in my email. As it is now, I've been checking Twitter about once a day. So we've hit over 30 minutes. I am signing off. I got a podcast to do, as I've said for the millionth time. So I love you guys. I will do this again soon. When I got news, this is so much easier than me scripting a video, filming the video, editing the video, putting on B-roll. That McDonald's video I did literally took about 4 hours to do. So it took about 4 hours to do that. Where this, man, I spent maybe like 15 minutes putting some notes together and then I just, boom, go on live and this will become a video. So, sorry, looking at myself talk, thinking like, this is like still so kind of weird. Anyway, you don't want to hear that. I got a podcast to do. I love you guys. Thanks for joining the channel. And Jack Black, love it. Go Cubs. Let's hope for the playoffs this year. Maybe we'll see. So, all right, everybody, I'll see ya on the